August inflation came out red hot at 8.3% and the markets have collapsed again. Now the S&P is down below 3,900 and all those temporary gains have evaporated. The bear market rally has failed. Inflation is going to stay high and the Fed now has no choice but to destroy demand. Powell is going to unleash the Kraken, guys. He's going to unleash a stronger dollar that will smash global markets into pieces. Now, there's going to be a good chance that the Fed slaps the market with a 100 basis points hike. Now, this is very dangerous because the Fed funds rate is standing at 2.5% today. This could be a historic hike that will get interest rates near 4%, but it's still not going to stop. We need to understand what the Fed is watching. They are not really paying attention to the headline inflation because technically it has dropped from 9.1% in June to 8.3% in August, and that should be good news, right? But the problem is, the Federal Reserve is tracking the core inflation or sticky inflation that takes away energy and food prices. And core inflation has actually increased by 0.6% from July. In fact, since August 2021, core inflation has been rising non-stop from 2.3% to 6%, and the Federal Reserve is very worried. This is the reason why Jerome Powell can't sleep at night, and it's because sticky inflation is the hardest to get rid of, and the only tool they have is to destroy demand. They are going to make everyone poorer so no one has money to spend on anything. So we know borrowing costs are going to climb, and everything from mortgage rates to car loans are going to soar. More money is going to be channeled towards those monthly payments. You can't spend on stuff that you like anymore, but only on things that you need. However, that is the most obvious consequence of the rate hikes. We have to talk about the bigger disaster which is about to unfold. The US dollar is about to soar, and this will start a domino effect of horrible disasters. We are talking about a global currency crisis, especially for emerging markets. We are going to see many countries experience an insane inflation spike, plus debt defaults are going to go through the roof. It's not just the United States that's going to experience demand destruction. Many people overseas are going to get a whole lot poorer. And this is going to boomerang back on the US markets and drive everything down, right? Stocks are going to crash. Commodities like gold are going to go down further. And real estate prices aren't going to stay strong for long. Now, we are seeing the US dollar gaining phenomenal strength. It has gone on a tear for the last 6 months from under 95 points to near 110. And that is a huge move for currencies in such a short period of time. This is one key reason why the markets are collapsing. Many investors are spooked out and they are fleeing from every risk asset known to man. And guess where they are going? They are hiding in the perceived safe haven, which is the US dollar. And according to Citibank, the only place to hide is in US dollars, and the only way to cure high inflation is through a deep recession. This means money is going to leave the system, whether it's through higher rates or people losing their jobs. Suddenly cash is going to be more valuable, and people are going to be stacking dollars, and this is bad news for the stock market. We can see that ever since the rate hike salvo started, the dollar has been inversely correlated to equities. Now, this is an inverse chart and it shows that as the dollar index gains strength, equity prices crashes even more. And it's getting worse. Normally, when the stock markets collapse, investors will start to stash their money into US Treasury bonds to get a return. But even that isn't happening anymore. We can see the US 10-year Treasury spike up to above 3.4%. Investors have even lost faith in bonds because they know interest rates are going to come in fast and furious. It's going to go up. What's the point of buying bonds today when the Fed is going to hike rates to the moon? And this is very dangerous because this flight into dollar cash is sucking money out of the system, making the dollar stronger than ever. We even have another yield curve inversion where short-term rates are higher than the long-term rates. The 2-year Treasury has smashed past 3.9%. Higher than a 10-year because people are bracing for the absolute worst from the rate hikes. And as the dollar gets stronger, the rest of the world gets closer and closer towards a full-blown currency crisis. So let's say you're a foreign country that imports a lot of stuff from overseas. You buy oil, you buy wheat, you buy electronics. Now suddenly everything has gone up in price because the US dollar is the reserve currency. Over 70% of transactions in most parts of the world are done in dollars. You cannot escape it. And this is extremely bad news if you're a huge importer of commodities to run your industries like Japan or China. And if you're in an emerging market just looking to buy food, you are screwed as well. Remember, food is priced in dollars as well. Food inflation is over 14% in Egypt, it's 33% in Iran, and an insane 122% in Lebanon. So we can see the chain effects of rate hikes and what they're causing. Higher rates trigger a flight to dollars that devalues global currencies, causing inflation to soar. And this places countries in a terrible position. They have to choose between two evils. Do they let inflation ravage the country or also hike rates to crush demand and bring down inflation? Remember, we are still living in a highly globalized world where trade is still interconnected. And if a country becomes poorer, it will affect other nations. We have central banks worldwide in a race to catch up with the Federal Reserve with the rate hikes. Almost every country today is hiking. Both emerging markets and developed countries are going to have to jack rates up even further or face an out-of-control inflation crisis. For example, we have the ECB hiking their benchmark rate by 75 basis points, and that's considered huge for the Europeans. But that just brings it from 0 to 0.75%. It is as good as nothing. It is not enough to fight the Eurozone inflation of 9.1%, especially when winter is coming and gas prices are going to spike even higher. Now, what does this tell us? More global rate hikes are coming. The ECB is going to hike, Australia is going to hike, Canada will hike, and the whole world is going to hike. We are going to see demand destruction on an epic scale. Now, I hate to be the bearer of bad news. I am slowly morphing into Dr. Doom, but I gotta say the obvious. The markets are gonna collapse further. Likely, we will at least test the June lows of 3,700 in the S&P, probably by Christmas when winter arrives. And it's very simple to understand why. The stock market is facing two enormous headwinds that are smashing it to the ground. Now, the first is simple. Local demand is going to evaporate. Layoffs are coming and the record low unemployment rate is going to shoot up. Higher rates are going to impact every industry, and we can see it causing pain to the most leveraged ones. We are talking about tech companies and big Wall Street banks. Twilio, for example, is about to lay off 11% of its workforce. That's over 800 people who are going to be jobless soon. And the main reasons cited were poor operating margins and high operating costs. Remember, as inflation rises, there's more pressure on companies to pay employees more. So they can either choose to sacrifice the bottom line or fire people to save more cash. Which do you think they're going to choose? And on the banking side, we have Goldman Sachs leading the way with hundreds of job cuts this month. And the reasons are similar. Their expenses are going through the roof and the number of deals closed is dropping. Goldman is trying to stay ahead of the curve, so they are reinstating their annual purge of employees. And if you're a low performer, you're out. And layoffs are going to hit Main Street very soon. We have a survey by PwC showing that over 50% of employers are expected to cut their headcount. 52% are going to freeze hiring and 44% have rescinded their job offers. Companies are going broke and they are running out of cash. The era of cheap money is over, guys. Companies can no longer afford to borrow money. Just check out the yields for corporate bonds. We can see for US corporate bonds, the bond yield is 5.14%. And just a year ago, it was less than 2%. The borrowing costs have more than doubled. And as we move towards the BBB bonds, it is yielding 5.45% from just 2.2% 12 months back. And the CCC rated bonds are a disaster. They are now at 15.4% yield. Do you know how insane that is as a cost of borrowing? Every business, big or small, can no longer grow like before. And the situation is going to get worse as rate hikes continue and the stock market will have to price in these realities sooner or later. So conditions in the US are getting tighter. Now let's couple this with a global economy that's about to slow even further. Demand destruction is going international. It is not just exclusive to America. And this is very bad news for every asset class known to man. If we track the performance of the S&P, we can see companies with more exposure from other countries are taking a bigger hit than those from the US, down by almost 10% more on average. And it makes sense. If the dollar is soaring but products are priced in a local currency, dollar revenues are going to drop. Plus, if things get bad enough, customers are just not going to buy stuff. things are getting very serious, guys. Take Europe for example. Their inflation is so high today, companies can kiss goodbye to any holiday sales or Santa Claus promotions. People in the Eurozone, they have barely enough money for food and electricity. And there's seriously no good news today. And whatever rallies you are seeing are likely going to be short-lived. I created a post recently that summarizes the broken state of the economy that I want to share. Number 1, the US is in a technical recession. We have 2 quarters of negative GDP growth, and I don't care what the White House says. Number 2, winter is coming for the EU with a Russian gas shutoff. People are going to bleed money. Number 3, the US is still spending more money on security assistance to Ukraine. This is bad for inflation. Number 4, the EU is bailing out energy companies, bad for inflation again. Now 5 and 6, China's growth is slowing and they are tackling a real estate crisis. They won't have time to go out shopping, retail sales are crumbling. Number 7, global rate hikes are not stopping. Number 8, CPI inflation is persistently high above 8% for 6 months straight. People now believe inflation will stay high. They are going to change the way they behave. Number 9, the global dollar debt crisis is going to get worse, and when you are broke, you can't import stuff. And number 10, the incoming oil and gas price caps could spike energy prices again. Inflation is going to stay high. So you can see there's really no good news I can spin. And all this is going to lead to prolonged stagflation. We are going to experience high inflation as rates continue to rise for quite some time as well. Make no mistake guys, the Federal Reserve is going to have to keep rates high for longer than usual. This is not a game where all they need to do is to touch 2% inflation again and then declare victory. They need to keep it down for a sustained period of time. Jerome Powell has to convince the public that the inflation demon has been sent back to hell. He needs to readjust inflation expectations long enough for people to have confidence in stable prices. Only then can he do the pivot that everyone is waiting for, right? Only then can he start lowering rates and start printing money to inflate the economy once again. I think by now everyone knows this BS pattern. But for now, this means rate hikes are going to continue, and I won't be surprised if we end the year near 4 or even 5% interest rates. And once rates reach their peak, be mentally prepared for the Fed to keep them there for 6 to 18 months at the very least. And this is very bad news for the stock markets, right? There's nowhere to run. Stocks will get smashed down and stay down. We have Morgan Stanley predicting the S&P to collapse to 3,400 by year end and even hitting 3,000 if a recession hits the economy. So there's probably another 20% left to go in this disaster. Precious metals are also going to get squeezed as higher rates are bearish for gold. Silver will likely perform a little worse because industrial demand will fall further as manufacturing slows. But on the flip side, we need to understand that the biggest fire sale is coming soon, and if you have cash, you'll be able to snap up assets across the board at awesome prices. So understand this and get ready for more downside, because once you're aware, you can get prepared and not scared. So let me know what you think in the comments below. How far will the Fed take interest rates? How much further can the markets collapse? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.